What's the best way to value real estate for my net worth? Imagine trying to figure out how much your house or rental property is really worth. It can feel like solving a puzzle with many pieces. When you're calculating your net worth, knowing the true value of your real estate is key. But how do you get an accurate number? There are several methods, and choosing the right one depends on your property type and financial goals. One common way is called the income capitalization approach. This method works best for rental properties or buildings that generate income. It looks at how much money the property makes each year, called net operating income. Then, it divides that number by a rate called the capitalization rate, which reflects what similar properties are earning. The formula is simple. Property value equals net operating income divided by the cap rate. This method ties the property's worth directly to its ability to produce cash flow, making it very useful for investment planning. Another approach is the discounted cash flow method. It's a bit more detailed. It projects future income from the property over several years, then discounts those future cash flows back to today's value. This takes into account the risk and the time value of money. It also estimates what the property will be worth at the end of your holding period. This approach helps long-term investors see the total expected return and understand how the property fits into their overall financial picture. The sales comparison approach is straightforward. It looks at recent sales of similar properties nearby. If similar homes or buildings sold for a certain price, your property's value should be close to that. This method reflects current market conditions and is especially good for residential properties or when good sales data is available. It helps ensure your valuation aligns with what buyers are paying now. The cost approach adds up what it would cost to replace the building minus depreciation, then adds the land value. This is useful if the property is unique or hard to compare with others. But it doesn't consider income potential directly, so it's less ideal for investment valuation. Finally, the price per square foot method divides the property price by its total square footage. It's quick and easy but less precise because prices per square foot can vary a lot depending on location and property type. For your net worth, it's best to use methods that focus on income potential, like the income capitalization or discounted cash flow approaches. These give a clearer picture of how much your property is worth based on its earning ability. It's also wise to compare these estimates with market data to make sure your valuation is realistic. Remember to update your property values regularly, especially if real estate makes up a large part of your net worth. And consider any mortgages or liens that reduce your equity in the property. In summary, the most reliable way to value real estate for your net worth is to combine income-based methods with market comparisons. This way, you get a realistic, comprehensive view of your property's contribution to your overall financial health. Keeping your valuations current and accurate helps you make smarter investment decisions and plan for the future with confidence.